Good morning and welcome to today's market briefing. Let me walk you through the key data points shaping the session. On the US side, the Nasdaq 100 ETF QQQ closed at 738.31, the S&P 500 ETF SPY at 756.48, Nvidia at 211.14, and Tesla at 435.79. The VIX Volatility Index is sitting at 15.32, suggesting risk sentiment remains relatively calm. The 10-year Treasury yield is at 4.45, while the dollar index DXY has broken below the 99 handle to 98.91, hitting a fresh low. In commodities, Brent crude has climbed to 92.05, WTI at 87.36, and gold continues its strong run at 4,560.50. Bitcoin is also showing strength at 73,738.18. Turning to China, the Shanghai Composite closed at 4,068.57, down 0.73%, while the Chinext board dropped sharply by 2.11% to 4,037.95, and the CSI 300 edged lower by 0.45%. What these numbers tell us is that we are looking at a highly divergent market today. Risk appetite is clearly fragmented, with Chinese assets under pressure while US tech stocks and Bitcoin continue to attract capital. Our base case for today is that US stocks will lean bullish while Chinese equities remain under pressure, with a probability of around 65%. The core logic here is that a weakening dollar combined with Fed Governor Waller's dovish comments has opened the door for rate cuts, which is supportive for risk assets. Looking at global capital flows, Asia is feeling the heat. The Chinext board dropped over 2%, and the probability of foreign capital outflows is around 70%. In Europe, Brent crude has already pushed above $92 as geopolitical supply concerns drive money into the energy space. US futures are pointing to a positive open, and the dollar index at 98.91 is sending capital out of the greenback and into non-dollar currencies and gold. The overarching flow pattern remains one of capital exiting Chinese equities and rotating into US stocks and commodities, with a probability of around 72%. On the macro front, the interest rate environment is neutral to bullish. The 10-year yield at 4.45 combined with Waller's dovish tone has boosted expectations for rate cuts, with a probability of around 68%. The dollar index breaking below 99 is bearish for the greenback but bullish for risk assets, as capital flows into non-dollar currencies and gold, with a probability of 75%. On inflation, core PCE at 2.8% came in above expectations but was flat month over month, so the situation has not deteriorated. We put the probability at 60%. Geopolitical risk is clearly bullish. Houthi attacks on a Red Sea oil tanker have pushed Brent above 92, and gold is moving higher in tandem, with a probability of 70%. For core assets, we rate US stocks as leaning bullish with a 65% probability. The supporting logic is a weak dollar, dovish Fed commentary, and continued inflows into tech ETFs. QQQ at 738 is a key level, and we are watching for a breakout above 741.5. For Chinese equities, the bias is bearish at 70%. Domestic capital is dominant but the PMI reading of 50.8 missed expectations, the Chinext board has broken below 4,100, and foreign capital is accelerating its exit. Bitcoin is showing a bullish risk appetite signal. ETFs have recorded net inflows of $310 million for 8 consecutive days, with a probability of 68%. Commodities are carrying a high premium. Gold at $45.60 and Brent at 92 already reflect significant geopolitical risk, and the probability of a pullback is around 45%. The capital flow theme is clear. The first main thread is weak dollar strong tech. The direction is to go long QQQ and Nvidia, with a probability of 68% and high continuity. The second thread is capital outflow from Chinese assets. The direction is to short the Chinext board or hedge, with a probability of 65% and medium continuity. There are a couple of high-frequency trading points to watch. First, if the 10-year yield breaks below 4.40, it would reinforce rate cut expectations and could trigger an acceleration in tech stocks, with a probability of 55%. Second, if Houthi attacks are confirmed to be expanding, Brent could push toward $95, but the current premium already reflects a lot of this risk, so chasing the move higher carries elevated risk. On the risk side, we need to keep an eye on core PCE at 2.8%. If inflation data rebounds in the coming months, the rate cut narrative could reverse, which would be negative for tech stocks. Also, if the Chi-Next board breaks below the 4,000 level, it could trigger a cascade of selling that drags on global risk sentiment. In terms of trading strategy for today, the bias is to take a controlled long position in US tech while hedging Chinese equity risk. The confidence level in this strategy is 65%. For entry conditions, if QQQ holds above 738 or pulls back to 735 without breaking lower, a light long position can be considered. If the Chi-Next board bounces to around 4,100, adding a short position is reasonable. For adding to positions, if QQQ breaks above 741.5 with volume, add to longs. If Bitcoin breaks above 75,000, add to crypto longs. For reducing positions, if QQQ falls below 735 or the VIX rises above 16, cut long positions by half. For stop losses, if QQQ drops below 730, exit longs. For the Chi-Next short, the stop loss is if the index moves back above 4150. Finally, here are the verifiable predictions for today. First, QQQ will close above 738.31 with a gain of 0.3 to 0.8%, probability 65%. Second, the Chi-Next board will continue to fall by more than 1%, with foreign net selling exceeding 5 billion yuan, probability 70%. Third, Bitcoin will trade in a 73,000 to 74,500 range and close no lower than 73,500, probability 60%. Fourth, gold will rally intraday but close between 45.40 and 45.80, probability 55%. Fifth, capital will continue to rotate from Chinese equities into US tech, with the Nasdaq outperforming the S&P 500, probability 62%. To sum up, today's market has a 40% probability of an upside move, 35% probability of a sideways consolidation, and 25% probability of a decline. The dominant theme is divergence, with capital continuing to shift from Chinese assets into US tech and Bitcoin. The key takeaway is to stay nimble, manage position sizes carefully, and trade with the prevailing flow.